The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent a loss. The views expressed represent the personal opinions of the presenter or featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cindia is an investment advisor representative of, and advisory services are offered through USA Financial Securities Corporation, member FINRA SIPC, a registered investment advisor. Life Stages Advisory is not affiliated with USA Financial Securities. Life Stages Advisory, Dean or Remington, or any guest we have are not affiliated with USA Financial Securities. Welcome to episode 65 of WTF, Wealth, Tax, and Finances. I'm your host, John Cindia, certified public accountant and personal financial specialist. Today we're going to talk about stocks and what to look for in a stock. Currently, their market is still going up. There's so much speculation. People are buying just about anything. Somebody famous, I won't not drop any names, but just about anybody that opens their mouth and says, hey, I think you ought to buy this, they buy it, whether it's crypto, whether it's stock, whatever it is. And when that happens, something else is probably going to happen in the stock market, because everybody who's never invested before, it seems like they're getting into this market. And just a few tidbits of info that I'd like to share, that if you're actually going to invest as opposed to speculate, certain things that you want to look for, okay? Stability in a company, obviously. We're looking for something that's been around for a little while. I'm not telling you to not speculate or not to look at any IPOs, but whether the way you want to invest is going to be for the long term. And I'm not looking at doing trades, and I'm not looking at turning around and doing day trading. That's not what this is about. This is for long-term investors. People who want to build some type of a good base and not get rich quick. That you've got some time on your hands and you want to start looking at something that's going to be solid, because we've been able to get 60, 70, 80%, 110% returns in this market off of stocks that have been around for 50, 60, 80, 100 years. And when you start looking at things of that sort, you don't need to do speculation and risk your money. So what you want to do is look for a stable company. It's been around for a little while. You look at the institutional buying and look at it from the standpoint, when I say institutions, other corporations, other businesses that have purchased their stock. Because the large corporations, they actually get what they call a dividend cut that they have. It used to be 85%. I believe it's still about the same. So for every dollar they get, they've got an 85% deduction that they can get for dividend-paying companies, so that they can put that into their portfolio in the corporation and utilize that from an internal standpoint. So you want to look at the institutional buying. I try to stay around 50 to 60% institutional. If it's more, that's fine. We look at it from that standpoint. Do they have dividends? There's a lot of good growth stocks that don't have dividends that may at some point, once they've matured, maybe they're 20, 25, 30 years old, then they may start to pay some dividends. If they don't have dividends, and just look at the structure, have low debt. Their debt to equity is low compared to their peers. You can get formulas and statistics and stuff, at the library or online or whatever at this point, to look at some of the different ratios. I'm not going to get into all the debt to equity ratios or inventory turnovers. I'm not getting into anything from the financial aspect. I'm just going to look at it from the standpoint of what you should do to at least narrow down what stocks you want to look at, because you can go into consumer staples, you can go into utilities. different types of financials, whatever. They're all going to have their own specific areas that they're going to be more concentrated in that you want to look at. But when I'm talking about an overall stability of the company, something that's been around 15, 20, 25 years at a minimum, just the fact that they're paying dividends, I don't look at that. I look at somebody that's paid dividends for 15 to 20 years minimum, but they're also increasing. And if you ever look at what they call dividend aristocrats, you'll always see a top 25 or top 50 that will show increasing dividends that have gone on for at least 15 years, some of them 20, 25 years. So that's going to be a very good way to look at that and see, what they obviously have great cash flow. You want to look for that. You don't want to look, you want to look for increasing sales. So even in a recessionary time or a pullback in the economy, you want to make sure that there's still stability there. They've got a lot of cash on hand. You've got a lot of these technology companies that have billions and hundreds and tens and hundreds of billions of dollars in cash, and they're looking for places to deploy that money. They're obviously a very strong balance sheet that they have, that they've got assets in that. But if they're not paying any dividends, it's not really doing anything. And if they're not on a huge growth, increasing their growth capacity, that's not really doing a whole lot for you either. It's just something that you're holding and hoping that they go up. So when you start looking at the different nuances of some of the stocks, you can get into looking at the board of directors and all that, but you've really got to be an analyst to get in to see what's happening there. You also, which I don't do a whole lot of, excuse me, from a standpoint of worrying about who's managing the company. It's more of a situation that you'll see a lot of the ESG stocks now, the environmental, social, and governmental. Those are very specific. They are for people who I think it's more of a political situation than it is anything. I don't necessarily look at those wholeheartedly. I've had some clients that have requested that, and I'll take a look at them from that standpoint. But it's not that I wouldn't look at an ESG type stock. I know I have, but I don't look at it as an ESG stock. I look at it as a corporation that is going to be able to help me or my client do what it is that we're looking for, whether it's growth in the portfolio, whether it's stability, whether it's dividends, cash flow, whatever it may be. Same thing on the real estate side. There's a lot of real estate investment trusts or real estate companies that you can look for. You'll see a lot of them that will have high dividends, and you have to watch out because the high dividend looks good, but a lot of the times that dividend is comprised of not only earnings, but also a refund of some of your original stock. So it's principal that's coming back to you. That's how they're able to maintain like a 7 or 8% cash flow, which may be okay as long as you understand what that's doing, what that's for, and that your actual holdings are sort of being depleted at the same time, unless they can hold that value based on the increase in the price of the stock. So, there's a lot of nuances into different types, and so what you're looking for, whether it's an income strategy, if it's a growth strategy, if it's a value play. A lot of the analysts right now are looking at saying that value stocks are going to be more in favor of growth stocks over the next several years. That could be true. If we have a pullback, you're going to have a lot of these growth stocks going to become value stocks. So you're going to have an opportunity there. I don't know if that's what they're talking about because the market is so inflated at this point that almost everything is going up. And when everything is going up, to me, there's not a whole lot of value in the market. They're looking at different price earnings ratios. And to me, it's hard to look at those when we're 150 to 175% up above where we have been on a historical basis whenever there's been a correction. So when you start looking at the situations from 2000 to 2008, 2013, and where we're at now, some of the analysts are looking and saying that, we have a long ways to run yet. Well, I think we have less upside than we do downside. I think we've got a lot more downside to come. It hasn't started yet, but I still anticipate something here probably before the end of the year. So I think what you need to do is there's nothing wrong with taking profits. There's nothing wrong with looking at it from a stability standpoint. It's not timing the market. We've had some clients that were up anywhere from 60 to 120, 140% on some stocks, and we're talking industrials over the last 14 to 18 months. So, we were starting to pare down some of the holdings over the last couple of months. Now, is it early? I don't know if it's early or not. I'm looking at it that if you're up that much, there's nothing wrong with taking some profits. Market will probably come back, definitely, and those stocks will drop. And when as high as we are now, I think the market will probably overcorrect, and we'll have a lot of opportunity to buy back into these quality companies. You guys have any questions on any of that stuff or any specifics?
It's always seemed in the research that I've done that like dividends is like, if they offer a dividend, it's pretty much a sound investment, at least in the way that I've understood it. So you mentioned that, typically you're looking for a company that's been around 15 to 20 years at least, and, and has a proven track record. So what decides a company's ability to offer a dividend, and at what rate? You know what I mean? Like at what rate do they decide that the dividend is this percentage?
A lot of it's going to depend on, their actual cash flow situation and everything. The velocity of the money that they can turn over and be able to see what their sales are, it gets into their inventory turnovers and stuff, and how much of their cash flow. So if they're looking, they don't have a whole lot of debt and they've got a lot of cash, a lot of these companies will still turn around 3, 4, 5% increase on a dividend on an annual basis, and already have like a dividend anywhere from 3 to 4%. So a lot of that, and those are industrials a lot of the times. If you're looking at utilities, the same thing. If they've almost got something like, if you'd look at the utilities and some of the financials, the cash flow that they have is unbelievable, and especially on the utilities, because they're pretty much a monopoly in the areas that they're dealing with. So
right,
they know what it is that they're going to have. They can pretty much dictate the cash that they're going to generate and how much free cash flow they're going to have. Then it's just a matter of how they want to deploy that. Some companies, if they're a lot of brick and mortar, they're going to have to factor in their expansion and the building costs into that. They'll do all that first and then see what's left. It could be, depends on what their markup is. It could be 1% they figure they could afford. It could be 5%. And then it just sort of depends on, what are they looking at, what types of individuals are they looking at to actually own that stock. If they're looking at individuals that strictly want growth, they're probably not going to look at a dividend stock. And if that's all they're going to do is growth, they don't care about paying a dividend. Once the other companies become, stabilized and they've got a cash flow that's consistent and the margins are high, then they've got the ability after a few years to decide, yeah, we can pay this out and we can maintain the dividend and even increase it. So once you get into the technicals and the financials internally, then it's a matter of what they think they can do on a projection of sales and everything to maintain that and just keep the dividends going. But I think you'd have to almost look and confine the dividend percentages into what sector they're in. and you're going to see them. They're going to have to be competitive if they're paying a dividend within the financial sector, within a utility sector, or whatever. So if you'd look at a bunch of utility companies and get a perspective, whether they're on the East Coast, the West Coast, or in the South, or whatever, you're going to see that they're pretty close in dividend payouts to each other within a percent or so.
Yeah, just to be competitive to get people to invest.
Yeah, from that, because you're not going to see somebody at 1%, somebody else at 8%. They're all going to be somewhere based on how efficient they are between 2.5% and 3.5%, 4%, whatever. And a lot of them have increased so much that if they started at $40 and they had a 4% dividend, they could be $80 and the dividend's at 2%. Well, it's the same dividend they were paying at 40. It's just the fact that
the stock itself's gone up in price, so I mean you're still getting the same dividend regardless.
Right.
Okay.
So if you bought that and it's still paying it, now if it turned around and actually went down, then you've got an issue there to.
Would you see companies do something like that where they would drop that dividend percentage? And would that scare somebody who's maybe looking at past history?
If there's a company and it has an opportunity to pay a dividend for the clients, and with the clients moving more from a pre-retirement to a retirement phase, and the fact that you can't get more than 0.5 to 1% at a bank unless you're willing to commit to several years at 1 or 1.5%, which was crazy on a CD. If you can't get anything out of an annuity, a decent annuity for right now, I think it's paying 2.5 to maybe 3% if you can find one for somewhere between 4 and 5 years. But you've got a dividend stock out there, and if you're just looking for it for income, and we've got some growth capabilities out of it, almost like a value play. If some of these would pull back, you get back into them. Their cash flow's still stable. Then, if they're at a 2% current dividend rate, I don't look at anything. Usually less than 3 from a dividend payout.
So you're really looking at better than an annuity or a CD or anything like that.
Yeah, I want that
high interest savings account. Doesn't matter.
Yeah, and that's the thing. If I can get something from that standpoint, then we'll be in good shape. But I just don't like doing anything less than that, because if the market's that high, I'd rather wait and pull back, let them get back into the 3.5, 4% range, and then start looking. So that way I know I've got some upside to the stock. I've got a dividend paying me while the stock's recovering. Okay, so I can get some upside there too. So and there again, it's not like we're gonna if there's an opportunity to sell something, take a nice gain out of it, and then redeploy that money into something else that's just as stable, there's nothing wrong with taking profits, broaden that base, then you can even have more dividends to pay out. Not that I don't utilize some principal on some of the clients to live off of, but if we're looking at it from a stability standpoint and making sure that they've got cash flow, we can always liquidate some if they wanted to have a trip to Italy or something like that. But if they're looking to pay bills and do normal things and have some left over at the end of the month, the dividends to supplement Social Security and maybe some pension if they have is fine. But I think people got to get back to basics again, and rather than all this speculation, because it's just sort of running rampant. Money's getting thrown at everything, and a lot of it's not going to withstand any pullback. So it's getting some gold, silver, getting some from there, getting a nice deployment of cash that you can have ready to go back into the market once the pullback is there. But it's just right now just picking and choosing certain stocks and that feel you feel comfortable with, and just making sure that the clients understand why you're picking it and what it's going to do for them. If you're looking for income, that's pretty much it. But yeah, there's a lot of different criteria that goes into that are more specific. But I think if you just look at those basics, that's going to give you a good foundation to look at, and just be just be careful with what's going on. You can do you can watch all kinds of analysts. There's so much stuff online. But, you just have to start looking at something that, write down 5 or 6, 7 different criteria that, you're looking for that make you feel comfortable. And if that's the case, then start looking at it and narrowing it down from there. And it's just a matter of
I mean, like what I'm thinking about is, you do have these people who are making big money on some of the cryptos, some of these, I don't even know what you want to call them, power plays. I don't even know what you want to call them, these big Reddit stocks that are jumping up big. You have people who are making big money. If they had a good exit strategy, you just won out. You left with, $1 million, $1.5 million, and you weren't expecting that. So, and you played, purely off of speculation. So really trying to find that way to get that money back into the market at a reasonable rate, not something that might be $0 tomorrow or $2,000 tomorrow. Being able to put that money back into something that'll, make you some money over time, grab you some dividends, and actually, leverage that and have an insanely nice portfolio rather than I had one stock and that's it. And I think that was the thing for me. It was like I found myself putting all my money into one stock. Is that a problem? I don't know. I didn't know if my valuation of that company was good enough. So
I've noticed after diversifying all my stuff, because I was in that same boat. If I had all my eggs in one basket, I spread everything out, and I'm seeing better returns on everything. It's nothing crazy, but like if one of them tanks, I've still got other options going up. Yeah, I got plenty of backup.
I think that's my whole point of this video, with this idea was, all these people making a lot of money is like, you might want to consider, slowing it down. You made big, slow it down, and get into something that's a growth or an income stock that, is tried and true company that's, you're in a good set there. You're going to get a dividend, you're going to get a payout, and you put a lot of money into it, you're going to get a lot on your dividends too. So that's my whole idea of it.
And that's the thing. I was looking at something, there was an article about saying that, you have to have X dollars to have in a portfolio in order to pull out so much income, and they were thinking of different strategies and all kinds of ways to do this stuff. And, if it doesn't fit for the people, I mean, we've got people of portfolios that are getting $80,000, $90,000, $100,000 a year in just dividends. Well, they've got huge portfolios, that they're doing that with, and they're not even spending the dividends they got, So the principal and stuff will still be there. They'll pass away and just pass it on to, the beneficiaries and stuff.
No, that's cool. That's good information, to kind of, in a less of a, honestly, in a less more analytical and more of just a strength and weakness side of, is this company strong or is it weak? You're not really looking at all of the numbers. You're more looking at, do you like the product they sell?
Yeah.
Is that product going to sell for the next 50 years? You know, that kind of thing. So
yeah, and like I say, that the environmental, social, and governmental stuff, I don't look at stocks that way. If a stock does something that I don't think is right, I don't look at it that, was it a political play? It's just that I just don't believe in what they're doing, or something like that. And if I don't, I don't. Like right now is there's a lot of, marijuana stocks out there. There's a lot of gambling stocks. I mean, all kinds of different things that are going out there. And are they going to make money? Yeah, some of them do, some of them don't. You're going to have to watch where they're at.
See where their money's coming from.
Yeah,
too.
Where's the casino at? What kind of, are they funding it with all debt? Is it a stock situation that they're funding it with? So, there's a lot of different things that you have, that goes into that. And until you, really do some analysis and figure out what it is that you're looking for, those would be some of the basic guidelines I think that, utilize to see if that works. So, well, we want to thank you again for listening in. You can reach us at jcindy at lifestagesadvisory.com. Look for our podcast on
Apple Podcasts,
iHeartRadio,
Spotify,
YouTube.
Always plug the YouTube.
You always plug the YouTube. Yes.
John, do you know what to do on YouTube if you see our video?
I don't. What do we have to do?
Well, you should watch it. Oh, that's pretty cool. You should watch it.
Maybe watch it twice.
You have to click something, right?
Yeah, the like button.
Oh, the like button. That's
Yeah.
what it is.
And
Smash
subscribe.
that like button.
Smash the
Make
like
sure you're
button.
subscribed.
Okay.
Share this video with 1,000 people.
Yes. And we want to get our numbers up. They're
Right.
good. They're good now, but we want to get them a whole lot gooder.
The rookie
right?
numbers.
A whole lot gooder.
A whole lot gooder.
Very
Yeah,
nice,
It's
John.
a class act. Until next time, thanks again, and we'll see you soon.